Alright, hello guys, I'm glad to have you on board again today. We are the 2nd of January, so I wish you all a happy new year. And without further ado, we're going to jump right in to the things that I promised you. We're going to do a yearly or longer term time frames review, modeling the directions of where I think the market is likely or going to head to. And of course, we're going to cut that thing into two parts. Part one is going to be more about the modeling that is behind the idea and what kind of macro models I'm using to at least show a direction. Is the market likely headed to a slightly higher or higher stance, kind of a moderate same level, ranging, or a lower level, more prices are headed down. So finding all the models, those who are listening to me for quite some time know most of these models, but kind of a short-term reminder might actually help you a bit before going to part two, which is going to be risk managing. Basically, how do I put those things into risking capital exposition to these strategies? What are the targets, the way we should actually get there, the expected timings, and of course, the potential invalidations if things just don't go according. So that's the way it is, part one, part two. Immediately I see people saying, well, part one is bullshit, we don't need that, let's go straight to part two. I take away the trades of this guy and I can copy those which I think are the most rational. Well, that isn't the way to go. Basically, what has the most value in these actual forecasts and stuff like that we do is not basically the conclusion itself, it's the way I have used to get to that conclusion that matters the most. So actually part one is quite the most interesting in this couple series. The thing is that basically these two have to work all together. That's the way true professional traders actually succeed. And if there's one thing that 2022 has told us is that basically there has been a shitload of liars out there. Some of them were more smarter than others. But the thing is that basically liars are always end up being caught. There's only one thing the market does is filtering out the bullshit over time. So time will flush the bad actors any fucking way. They can lie, but they can't lie for too long. They always get caught up. So remember that you can lie to yourself as well, but the market will always catch up with it. So just try to be as rational as possible. No one knows the future. I don't, you don't, no one does. So let's try to be humble for a second. And just to say that what we're all trying to do is just trying to put out the best efforts to try being the most rational as possible without ever being able to be. Remember, no one is rational. No one can be. We're all biased. But the only way to reduce that bias to a strict minimum is to have a diversified set of models. And that is why part one is just as important as part two. If you just risk manage saying, I don't give a fuck about the market direction, I'm just about those ones who follow the market. Oh boy, I've seen those motherfuckers years over years. They don't last long in the markets because they're just plain full bullshit liars pretending they don't have emotions, they just follow the market, blah, 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 bullshit. True traders have ideas and they're basically, this is how they make money, but they do not make money just by trading their ideas. They do make money by combining trading as rational as possible ideas, accepting being proven wrong because no one predict the futures, and risk fucking managing those ideas. And that's by using these two, part one and part two, that you get a successful trader, or at least an as successful as possible of a trader. Okay, because no one can be just successful exactly perfectly each and every year. There are oscillations that are absolutely not relevant to you personally. It's just the market forces. You can't go up forever without a bit of being proven wrong. Being proven wrong is part of the markets. So without further ado, let's jump in. All right, part one. So we're going to review one by one. I'll try to go as quickly as possible because most of you guys are already familiar with those models. But I wanted, for those who are less familiar with the recurring consistent modeling that I do in this channel, kind of making a brief review of these models so that if they want to have a look at the parts two, they will at least understand the shit I'm talking about. All right, so first things first, I don't do forecasts in the way, these are my 2023 predictions and I think this and that will happen in 2023. This is not interesting to me. No one can do timing, so it will be stupid to put a constraint of saying this will happen by the 31st of December. No, I don't know. We're just going to say on a rational 1 year plus a couple of quarters, okay, so more or less 1 quarter, though expected Q1 2024 down to Q3 2020 2023 is what I expect things that could rationally occur. So the baseline in here is that we're going to take away weekly charts, monthly charts. These are generally the time frames that play into these time scales. So we're going to look at those charts, of course. Second thing we do, I don't do review of 2022, like these are the big moments of 2022, whatever, blah, blah, blah. No, doesn't matter. But still, we're going to have a look at those moments in 2022 that are still at play over 2023, or likely will go into. So all of the ongoing trends and models that have been playing more or less violently in 2022, and what are the ones that are likely still going to be at play in 2023, and we're going to, of course, have a look at which impacts they're likely going to get. There are lots of models. They're all above right here. Some models are more macro-oriented, which means they are more related to traditional markets, even though they have impacts on crypto as well. Some are crypto-specific factors, which we're going to have a look in the second part of that video. So let's get started. All right, first one is, I think we've had a historical decorrelation of two of the major market components. Sorry, this slide is in French, but I'll give you the TLDR about that. This is basically my decorrelation pattern system, which is when we go from one equilibrium state, which is this, to a second in a multifactorial environment. I mean, basically, you have one thing that has kind of a stabilized effect, which means there is still movements in here, but this is less perceptible. And of course, at some point, some of these subcomponents of that equilibrium state will start to decorrelate. Basically, these things tend to behave together, and they start to behave oppositely for a limited amount of time. One goes up, the other one goes down. And then, of course, out of a limited set of time, these decorrelated factor will inevitably recorrelate, though this is that decorrelation to recorrelation phase. What that pattern tells us is that the equilibrium state that we'll end up having in the output, in the end, after this decorrelation to recorrelation pattern, basically can't be at the same level. What that tells us is that there is always one of the two components that goes further than the other one, okay? And this one will give the direction. So normally we go in the direction of the one that has been the likelier, the correlated factoid in that system. Though basically, what I'm saying in here, to put it into a more rational vision, is that the market is using multiple factors. Okay, so what gives a market pricing in the end is, first of all, a lot of mathematical model to model how much of the supply is existing, how dynamic that supply is, but this can be done with math. These are reliable numbers that can be gathered, processed, and produce an output, which is, of course, depending on the math that is behind it, but there are multiple ways to reach out to a conclusion that is likely going to be the same for everyone. So there are mathematical models of markets that are more supply-oriented, that works very well. Basically, don't forget that markets do one thing. They do not relate to the economy. Markets are not going down because the economy is going down. Markets are not going up because the economy is going up. Markets are producing prices, and that's the only fucking thing that a market does. It produces an output price, which is supposed to be the current real-time best guesstimate of both the actual level of the economy, its current state, and the anticipation of where it's going to be in the future, because there is that second part in the market. It's not just math about where we are now, it's about expectation of demand. Though we've seen that supply can be kind of calculated and forecasted. But the demand is where the psychology goes in, because the demand can be either rational, coming from these guys who run models in the supply, which can anticipate that the supply is going to shrink or increase. And in that opposite way, they will orchestrate the demand for financial assets because of these supply constraints. On the second hand, there is the speculative demand, which is basically how many people want to be invested. And what are those types of people? The psychology, the anticipative demands of market participants. And well, we've seen that normally these two factors, the anticipated demand and the variations of supply, tend to work together in an equilibrium state. What we've seen is that now there has been much more speculation on the demand of assets and far less interest in the supply mathematical metrics in pricing in the markets since the Trump era, or the second part of the Trump's era. Basically, the switching point would be around 2018, and we'll see that when we look at the charts in part 2. But basically that pattern decorrelated, meaning that out of Trump's era, we started to kind of play around the market, communicating a lot, bringing a lot of noobs in the market, like, well, look at this, the Dow Jones breaking that and that. I mean, the fucking president of the US were tweeting more about the markets than the actual economy. So it brought a lot of noobs in the market. It was more about how many people is it going to be willing to bring in the market. And we've gone to decorrelating that stuff very violently to the stupidest level we're in, meaning basically the Fed were just playing with the supply, just breaking away all of those models, mathematical models, because basically there is an unelected set of people who were playing with the supply of money up to their own needs. Though they give us some of their models, we use inflation, this or that, but basically they've been talking a lot and not necessarily acting according to those stocks. So there has been politically motivated financial decisions on an unelected set of individuals, where on the opposite hand, there was just a over-politicization of markets, which was basically, well, you have to be in the market. That was the Trump bullshit era. Of course, I think these things have found their market top, though the higher spread there is in between the two. Meaning basically, we only care about psychology. It's all about the dumbs have gone in, we need to flush them out because they bought the market up, they're going to oversell, we're going to get a crisis, financial crisis. You know the drill. These are all the 2022 narratives that actually ended up being proven wrong very violently, and we'll see that through the charts. I think we've got to the tipping point of that spread, meaning basically everyone's saying, well, you know, all those financial models, P ratios and all that. This is bullshit, bros. You'd rather like to trade Bollinger Bands. It's all about the buyers and sellers. It's all about the speculators. We're just going to flush them every possible way, up, down, up, down, and it's all about market volatility. It's not. Like I said, it's in part of the equation, but forgetting about the math is absolutely utterly stupid. And thinking that math is just being proven wrong and that it's all about volatility is a bullshit stuff. Of course, that also tells us that we're going to go to an equilibrium level in which volatility will be a bit more present in the future than it did before. But that also tells us that on the recorrelation phase, the one that is likely going to get the strongest momentum is that the emotional state of market will actually decrease, but the mathematical takeover in the market or regaining strength is the one that's going to be the fastest in the entire decorrelation pattern. In terms of momentum, the catch-up phase is faster than the decorrelation. It also tells us that the one that's going to have to catch up is going to catch up very fast. So what that model tells me in the global market context that we're headed into 2023 is that starting 2018, ended up early 2022 tells us this is roughly 3.5 to 4 years. So that tells us that we still have 1.5 to 2 years to go into the recorrelation phase, and we're still in. So 2023 should still be in that recorrelation phase. So there's one model that tells me this, is that normally the mathematical end of the market is likely going to be more predominant in the years ahead, and the momentum is going to be very strong. Where on the opposite hand, slowly but steadily, the volatile state of the market, basically the stupid selling narratives to stupid people, is going to start decreasing its impact in pricing. That's one very good hedge that I have over the rest of market participants. If I follow that model, I know one thing, that the narratives are going to be there, but they're going to be less impacting prices than they did before. The volatility in the market should reduce and keep reducing for at least another year or a year and a half. And it tells me that the mathematical model should actually start to regain strength. So that tells me that likely the manipulation of supply, basically aka the Fed's action, are finally going to go down. We're going to go back to math, being able to predict the supply in a predictable manner, mathematical calculations, instead of just blindly following a set of unelected individuals gambling with the market supply. So I take two things out of this model. It's going to last approximately a year and a half. We're going to get a huge wind down of market pricing in the Fed, and the market will start to go back to mathematical model. And on the opposite direction, the stupid narrative and volatility-driven kind of external market forces trying to manipulate emotions will have lesser impact in the prices over time. That's number one model. Very important, I think, to take away. Second model is, of course, as I see, what's backing the first assumption is that the Fed gave us their model. They said, okay, we're going to follow inflation and so on and stuff like that. Though inflation can be measured out of two ways. The first one is the non-volatile way, using core PCE, which is removing the volatile part of inflation. And the Fed has given us their model. They're looking at 3 expiration dates, quarter over quarter, semester over semesters, and year over year, or growth rates. And they've said we will consistently think that the base layer of inflation out of volatile components is headed down when both of them, or all of them, will go down in the same time. And as you've seen, well, it's been completely messy over the latest month, but now we finally had the latest number, which was very great. We have sign that this one is headed into a year low, and have very good signs of keep on doing it, because the less the more rapidly responding factors are all going down as well, and significantly. The semester over semester is in an all-time low of this history of more than a year and a half, or approximately. This one as well is at an historical low, showing sign that the short-term momentum is definitely headed down, showing sign that this one is likely going to accelerate by the next release. So that's a pretty damn good sign that the base layer of inflation is cooling down. It's not nearly going back to where it was before. Forget about the 2% inflation. Remember that we're changing stage, and it's likely going to still be higher volatile. And I also think that we're going to have higher standards of inflation ahead for multiple reasons. The other factors that we need to take in is this one. We need to figure out, and I'm going to use that model for forever on now, is the app Trueflation, which is a very good site, by the way, which is breaking down all of the factoids in the actual inflation. And we see that the core elements, the ones you see there, are far less volatile, of course, and we can see what happens in the volatile part in here. So the utilities is a volatile part, transportation, housing, and food and alcoholic beverages are basically things that are taken out of the core PCE measurements. What we can see in here is that all of these metrics are all headed down as well. So the volatile components of the markets are all headed down. Transportation, heavy down. Utilities, they've gone up, but they're starting to show signs of weaknesses as well. So there's one thing to take out of this. I think energy and utilities are going to be the centerpiece of the stage in terms of inflation measurement next year, because that's the one that is supposed to start to cool down. Though how can it cool down when on the opposite end we are following a model, which is the economic confidence model, which tells me we're going to get a commodity boom. So basically the commodities are going to keep on rising prices, but how the fuck can they go down in the inflation measurements? I think that's one thing to take away from these models, to say there's a very likely chance for the year ahead, 2023, eventually down to 2024, that as the Fed goes out on the market supply manipulation, someone else is going to come and play in this market, and I think that's what's going to maintain inflation at a high stage. Who can that be? If the Fed doesn't support the market, who's going to? Well, I think a lot of people just forget about it. We've gone so used that the Fed can manipulate the supply of money in the markets, but actually there's one very big actor that can also do it in a less direct manner, but that is the government. Though I think 2023 to 2024 is going to be government spending of subsidizing commodity boom against to maintain the price of commodities, or at least not the price, but to maintain, okay, the utilities part, so the use of those commodities into a reasonably less inflationary manner. So there's going to be subsidies, subventions to actually make sure that the commodity prices are compensated, and that can take multiple forms. I don't think it's going to be direct paycheck on people's expenses, but I think there's going to be support to the economy to reduce cost prices and stuff like that, to repatriate some of the productions to back to home and stuff like that. There's going to be multiple, I think, spending behaviors from the government. Remember that last year as well, we've had the midterm elections. Everyone thought the Democrats were going to take a harsh hit, which actually didn't happen. They still control the Senate, and they've lost majority on the House, but not by a wide margin as it was expected. So there's still a quite significant chance that we're going to get some expenses in the next couple of years until we get to the new elections. That's the thing, okay? So I think another big topic to take out away from this is that there's likely going to be a lot of government spending one way or the other to just compensate for the commodity boom. And that's likely going to be, in my personal opinion, driven into targeting utilities. Transportations and all of these other ones have already started to go down significantly, though I think supporting food and non-alcoholic beverages inflation and utilities inflation is the way it's going to be for the government expenses. Healthcare as well, as you can see, is going up. So I think it's going to be one of those things that's going to be subsidized by the government spending. But that's the topic to take away, okay? The Fed is going to lesser its impact on the control it has over the supply of money. The Fed is just going to start being neutral again, okay? And on the opposite hand, the government spending is going to take over. So this is going to sustain the level of inflation because it's still, one way or the other, creating money out of thin air by creating future debt. And that's basically going to maintain inflation higher than before, but it's going to be subsidizing certain parts of the economy and subsidizing certain parts of the actual pricing systems, most likely going to be around utility, healthcare, and food and non-alcoholic beverages, in my humble opinion, which is totally consistent with Democratic's kind of way of seeing the markets, though I definitely see that there's going to be a much more politically targeted spending behavior, way more than the Fed will actually be winding its own down. So the Fed's impact is going to lower, the government spending impact will be more prone. All right, what we've seen as well is that I think 2023 is going to be surrounded by another Fed mistake because they've been making mistakes every single year for the past 4 years. Basically, 2019 was starting to go dovish too soon, though basically the market was going up and the Fed started to go down in its interest rates because the bond market has showed signs of real reverse curves. That was the sign that something ugly was going to hit the market and the economy. And remember back then I told you the market's going up for bad reasons. We're going to go down and it's going to go violent. And that's exactly what happened. I didn't know about COVID, but COVID showed up. That was very brutal and stuff like that. Those who were patient enough to wait for tinier prices to get in have been pleased because the COVID definitely delivered. Then 2020's mistake for the Fed has been basically opening the floodgates without any single limitation, going just as dovish as the narrative could be, like basically take the money, bros. This is free. Incredible stupid rhetoric back then. 2021 was the stupid thing about, well, we might have eventually given too much money out. We have signs of over liquidity, reverse repo starting to wind up and stuff like that. Remember, that was 2021. Okay, I'll give it a second. But we've seen that earlier in 2021, we had signs of over liquidity in the market. The Fed didn't listen. They were like, no, this is transitory, folks. Just give it a breathe. It's going to cool down. Of course, earlier 2022, next mistake. Oh boy, the inflation is out of control. We're going to have to preemptively and aggressively raise interest rates, blah, 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 blah. You know the drill. So 2022 is, of course, over-tightening. We're going to see that through the 10-year yield chart. There is a specific mistake that has been made in the November's decision to rise by 75 basis points when the bond market told the Fed to do otherwise, but they decided to still do it. So there was an over-tightening behavior in 2022, basically specifically targeted in the fact that they had to catch up with the 21's mistake by going aggressive, and they've made a final mistake in the November's meeting in which they should have gone 50 basis points if they listened to the 10-year yield. They decided to still go for 75 in a stupid way, and that's going to have negative consequences next year. Again, which means next year we're going to have deteriorated impact on the economy because of the bullshit of going very violent in 2022 and probably too much and too quickly, by having things that will start to break down probably 6 months after 3 to 6 months after the November's meeting, which leads me to believe that something's going to go wrong around May next year because of the rippling effects of the stupid 75 basis points that was too much in November. The final target rate, we've seen that, is very likely going to be at 475 or 500 basis points, which was my target all along, though the market is finally getting on the grip on that. So the 2023's narrative on the Fed is likely going to be plateauing the interest rate hikes, finding a plateau, certainly not pivoting, okay? And the mistake is likely going to be something I think is going to break down in around May or early June. And when it will break down, the market will likely say, okay, it's time to cut rates to support the economy. And the Fed will literally say, no, 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 bro, we've gone up. We've had to do it. It's been very violent. We might have over-tightened a bit, but we're not going to release anytime soon. We're going to have to plateau because that's our policy. That's where I think the Fed is going to be making the mistake in 2023 by following their own narratives. The narrative is we're going to go up and we're going to stay there, even if there are signs of deteriorations because of our preceding actions. They will make another mistake in 2023. I'm damn sure about it, and that's probably going to be we might have gone a bit too far, but we're going to stay there anyway because we said so. That's where they are stupid because they're supposed to follow the economy, and they won't. The economy will probably start to show crackdowns around the mid part of that year. They'll pay real attention to this in terms of timings on the year ahead. That's what I take away from this model. All right, next, very important to understand, big fucking mistake. Everyone is copying the stupid bullshit of the 2020, of the 2000 bubble, the 2008 context and shit like that. We're not in a depression environment because we're not in deflation, folks. We're in inflation and economic slowdown. So basically, we're in moderate stagflation now, so stop copying stupidly the 2008 models or the 2000 models or the 1920s. It isn't the market context. Simply not. Of course, we could pivot and change into depression, but for now, there are no signs of it. So don't be stupid enough to think about that. And another thing, very, very, very important to me, because that's the very, very underestimated force, is, to be honest, everyone's been talking about doom and gloom in 2022, 3. Ahead is going to be a shitty year because now the Fed is over-tightened. We're going to have the negative consequences. The economy is going to start to collapse and blah, blah, blah. But there's one thing everyone forgets about is that 2022, in my personal opinion, on the other end of the curve, there's been one very significant thing is that technology has been making some severe breakdowns. Or breakups, basically. The thing is that we had a significant improvement and discovery in the fusion sector, which is kind of very important. Remember that each and every macro cycle always starts with a discovery in the energy production sector. Basically, the Industrial Revolution has been flowed by the discovery of thermal energy, which is basically have been fueling by burning anything, coal or whatever, and producing heat. And this kind of allowed energy to be released in a thermal form and to be used and create the Industrial Revolution. Out of this, we've discovered electricity has been creating another industrial revolution of its own, and then we've discovered nuclear fission, which has given us kind of a cleaner but still radioactive way of producing energy, but in far larger quantities, and adjustability. And now we're on the verge to get into fusion. Though, of course, these things take a long time. I'm not saying it's going to be there by 2 years or whatever. I'm not stupid enough to go down timings, but all things settled is that I think it's going to happen anyway. It's a matter of time. It's a matter of when, not a matter of if. We're going to succeed in fusion. And yes, there are so many people saying, well, this is just people future telling about a bright and energy no energy problems anymore in the future. Look, this is stupid to think of it that way. There's still going to be problems. Fusion is not going to solve every human's problems, but it's definitely going to help because that's what technology does. It breaks patterns. It changes the narrative, changes the motive, and another new set of, I think, economical development of human beings is likely going to be triggered if we get fusion. And I can say if, I think it's a matter of when. I don't think it's nearing the future, but the recent breakdowns, the recent breakthroughs in fusions are definitely something that have been underestimated, in my personal opinion, in general market forces. This is something that is looming. It's not yet there, but it will. And that's something that you shouldn't forget. Second thing is that we had another breakdown, it's not breakthrough, sorry, in another very, very interesting thing is AI. Basically, I don't know if you've heard about GPT-3 and OpenAI stuff, but I sincerely recommend you guys use it because, boy, it's staggering. I've been using it myself. I've seen a lot of people talking about it, and I've finally found some time to actually do it myself, to just see for myself on what it is. And I've had some actually interesting things happening in here. It basically changed my mind on the fact that, well, I don't think in the future we're going to be using Google searches of some sort. Google searches might be things like that. Well, you actually have a condensed information feedback on topics that can be very, very targeted and specific. I've been asking for very wide questions like that, and I had some pretty decent answer. But as you dive down and going into some more specific answers, you have responses in a few seconds of things that are actually very, very interesting. And this saves quite a staggering amount of time in researching stuff. Boys, this thing is just a language model. And it does pretty damn great at doing such a thing. It saves quite some times in researching the internet by using it instead of a fucking Google search. And this is just one of the many applications in which AI has been making recent breakthroughs. So there are lots of things. Not to remind you that in 2022, we've created entire proteins out of AI modeling system. Lots of things have been discovered through AI in 2022. And that's something that I think a lot of people don't think of because it's all about doom and gloom, we're all going to die and blah, blah, blah. There has been significant breakthroughs out there. So that's one last thing into the big macro stuff. Understand that yes, there might be some concerning systems like us destroying the planet and stuff like that. There are some opposite forces as well. So don't ever turn out to be black or white. It's always shaded gray. Okay, so of course tech isn't going to save us from the shit that we've done. It's always going to be shaded grays in between. Though that's really important to me to remind you that. All right, on some more crypto related type of systems, we start immediately with the Grayscale Bitcoin Trust GBTC, which is still trading at significantly concerning discounts. That is the sign that there is still a problem going on with that thing. I don't think it's GBTC directly related. I think it's still the same old story with Gemini and this digital currency group, DCG, kind of big old scheme. So everything that is closely related to DCG is experiencing serious discount. That's the sign that there's probably some illiquid kind of liabilities out there. And until that get resolved, which means I don't know about GBTC's discount, but I think it's the tip of the iceberg. It's just what allows us to show where the current problem is. We know it's DCG related, but we don't know anything about the problem itself. I think it's too complicated for people to understand it. So just look at GBTC as a way to measure the evolution of that system. If it somehow goes out of this extremely low territory, the recorrelation back to some more normal levels is going to be very violent, and that's going to probably look like a relief rally because the market will start to figure out that there will now be further down liquidation scales and stuff like that. It's been the consistent modeling of people expecting things to go more shittier than before. Even though I have been proven wrong with the previous model by saying there will be nothing, I still expect one another exchange to go down. And I expected this to be a future-centric exchange. I never thought it would be FTX and that big of a bullshit. But turns out we can always be surprised by cheaters and liars. They always get caught anyway. Though the thing is that now people expect that there's more to come, that GBTC is inevitably represented, that DCG is insolvent, and that therefore more liquidities are going to flow out of this market. There's going to be more forced selling, and therefore the pressure still remains on the market. So until further notice, I keep that as a risk measurement factor, purely crypto-centric, which is, until resolved, considerably slowing down the market. It's considerably slowing down Bitcoin more than the others, in my personal opinion, even though we know that systematic problems can have rippling effects on outcomes as well. But I think it's putting a lot more pressure in Bitcoin. And that will explain the major factor which I think is putting Bitcoin into breaking its summer lows, where others, good actors like Ethereum, Atoms, and so like, didn't. We'll see all about that in the price analysis part 2. Though moving on to the next thing that I think is important and crucial to understand when it's crypto related, I think asset tokenization is the next big trend. It's already started, it's visible on multiple things like MakerDAO's kind of demand has been surging out of nowhere, demand for real world asset tokenization. And I think in this game, one asset is particularly going to take over than the others. As you can see, it's been sold way, way long ago. So that was still the same old stupid narrative, like we're going to tokenize everything. It was, boys, more than 2 years ago. And now we're really headed into this. I definitely think 2023 is going to be the year of adoptions of tokenized assets because of a more precise regulatory framework on top of other factors. But I think this is going to bring slowly but steadily innovation to go on-chain by the use of decentralized oracle technologies. One of them clearly leader in this market being Chainlink. Chainlink, which we'll see through the assets price structure that has been kind of the asset in 2019, 2020. Many people, me included, have been missing on that shot. It's been dormant for a couple of years until then, but I still believe the asset, the go-to-market strategy for Chainlink is definitely a must-have in a portfolio. Though I think 2023 might be a very interesting year for asset tokenizations stuff. Which was a thing of the past that has been said back then as, once again, a narrative, and now likely going to be truly adopted in the years ahead. Another big narrative of 2022 that's going to have rippling effects in 2023 is ultrasound Ethereum. The EIP 1559 is the keystone in fundamental metric changes of Ethereum. I've said it again, it's not bullshit, it's not a narrative, it's a true, absolutely fundamental change in the supply side emission of Ethereum, and that can't be fucking bearish. That's one of the reasons why I think Ethereum has made its bottom and will never test it again, but may still be under pressure as long as Bitcoin doesn't solve its problems. The thing is also that narrative of ultrasounding money is probably not going to be turning true now. It's the same old narrative that Ethereum has been sold to be deflationary when it's not. The EIP 1559 has been designed to put net emission to zero over time, which means there are inflationary moments, deflationary moments, inflationary moments, deflationary moments, but basically, aka over the longer run, we should still have an equilibrium stage. Because this thing has been designed to do just that. So I think these guys are very good at crafting things, and therefore they've probably designed something that will start to stabilize itself over net zero emission, which means there are still moments of positive emissions compensated by level of further demand, which will decrease that thing. There is also lots of concerns about the release of the next Shanghai Hub rate, which is going to allow Ethereum's validators to release either their staked tokens or just their rewards. My personal assumption in here is this is full of shit as usual. This is the same old narrative stuff. People sell you the narrative that everyone's going to sell. Well, I don't think it's going to happen. Best case scenario is that validators will take their rewards and eventually sell a portion of their rewards to reallocate to some more riskier assets, which will actually be bullish for the crypto markets, because this is not Ethereum that's going to be sold for dollars to cover for mining expenses or bullshit like that. Running a validator on Ethereum costs absolutely nothing, so there's no reason to sell Ethereum at a cheap price we're in. So it's basically, I think the best case scenario is that Ethereum is going to be collateralized either to loan or land or whatever, or just be exchanged for other more volatile assets, which will be the sign of the beginning of a bull market sentiment in the market. So I think Ethereum's merge release by the Shanghai's grade is actually going to be a pretty bullish factor. It's also going to create another cool stuff, which is basically removing uncertainty. Understand that for mathematical models, which we've talked about in a previous part, are going to take further and further impact in the years ahead by regaining their strength. Mathematical model on the Ethereum blockchain are pretty damn simple. For whoever has just a bit of experience in the market, they've all figured out that this is the 10-year yield of crypto. This is basically the safe yield. Basically, unless you are a bad actor in Ethereum, the reward you get by validating is like the safest yield you could get, just like the equivalent of a 10-year US government bond, basically. So this is the bond market of crypto. Having Ethereum and staking it is like putting into a bond. It's just exactly the way it is. Okay, so Ethereum is the base yield of a safe risk taking in crypto. So if you don't see where the demand is for that kind of thing, may I remind you about the 60-40 portfolio that's been lasting for decades? 40% exposition to long-term maturity bonds. That tells that 40% of net allocation for smart money managers in crypto is likely going to be in fucking Ethereum staking. So yeah, I think it's going to be a thing, and removing the uncertainty of when you can take your profits or eventually run out the validator, it was a significant uncertain factor for these professionals. They will have for now, they have no other options but to go in without knowing when they go out. By the Shanghai upgrade, this will be removed. That's an uncertainty factor that is pulled out the market, and that's generally bullish. Remove uncertainty and you generally have price reactions. Though I think this is going to severely increase the demand for Ethereum, not immediately on day one. There might be a bit of speculative, stupid volatility, but until then, I think it's a very net bullish occurrence for Ethereum that's going to happen Q1 2023 or somewhere around that. So that's for the Ethereum narratives. All the thing, boys, I've never seen someone being so stupidly proven wrong for so many years, but the Bitcoin maximalists, and I think they're still headed into more pain in 2023. So the reason back then is just pure math. If you have a look at this thing, the Bitcoin dominance will also see the same and paint the same old picture. If we have a look at the alt season indicator, we can clearly see that we're evolving in a rising channel. So this is not a trend because this is an oscillator, but there is a net shifting, okay? There's an offset that is increasing in the neutral level of that oscillator, which tells us one thing. Altcoins are taking the grip of a Bitcoin slowly but steadily as each and every cycle passes. Of course, these are ups and downs. This is an oscillator. It's meant to be doing this. So now we're in a down cycle. We're pretty much in the bottom area of that indicator, showing signs that, in my personal opinion, it's not about time to go into safe daddy Bitcoin. It's more in the thing that to say the next move is, yes, the risk takers are going to be back in. And I think 2023 is definitely going to be a year about altcoins again. And that doesn't mean Bitcoin is undermined and not making it. We've explained lots of those models, actually. It's a matter of timing. Bitcoin plays on a much longer run than the more disruptive other assets classes like Ethereum and the like. We'll talk more about that later, but that's one model that we need to see. There is a clear shift in the offset of that oscillator that clearly, persistently favors altcoins expositions against Bitcoin in portfolio. That doesn't mean having Bitcoin in portfolio is bad. It just means for now and until proven wrong, I think having Bitcoin as its major asset in a portfolio is not the way to go. If you are, of course, an investor looking for alpha and beta in the market. So I think the market is still about pricing in the revolution of cryptocurrencies in its multiple forms, and Bitcoin is a much longer play, a much safer daddy, but daddy is going to take some time, and for now, the market is still pricing in higher chances to see the competitors likely are taking the grip on the market more than Bitcoin does. That doesn't mean Bitcoin goes to zero or Bitcoin doesn't move. That means Bitcoin moves slower than the faster competitors. And that makes total sense. If we have a look at this model that we've talked about so many times, but I think this one has to be assessed in here as well, for those who haven't seen it or for those who have but needs a refresher. This is the adoption curve, which I refreshed a bit by a more pragmatic system. Though I have to understand, you have to understand this thing. This is the coupling of two models. The adoption model, which is basically a go-to-market strategy of multiple cohorts, the early market enthusiast and early tech participants, then followed by adoptions of visionaries. I've removed the percentage basis in here, but this is basically 2 to 2.5, from 0 to 2.5%, to 2.5% up to 5 to 10%. For visionaries, which are basically people who envision what this technology will be offering in the future. The next cohort comes with a chasm, which is basically where there's a massive shift in the supply. Basically, a lot of the supply is changing hands. This is kind of the big washing machine moment in which the visionaries generally end up getting into the trough of delusionment. Basically, we've sold that magic future to the public. They get to buy the narrative and ends up, of course, holding the bag on its way down. This is the same old stupid venture capitalist stuff. Basically, the venture capitalist builds the story, they sell their tokens to the retails, and once the retails get their tokens in hand, the market collapses on itself, and the same old small holders tend to hold the bags, and then they generally try to sell it back to either the same old VCs or some other longer term investors who seek value this time around, because this is a matter of cycles. Okay, once we pass the visionary phase, if the market recovers, there's only one way back to all-time highs. It's adoption. If you get through the chasm, which means after shuffling decks and moving tokens around with a huge turnout, once the token supply stabilizes, if it's in the head of smart money managers, okay, generally what tends to happen is that these guys will envision technological breakthrough. If they do this, then of course they take a risk. But if they succeed, meaning that past the selling the future bullshit stuff and truth of delusionment coming along with it, if the true innovation is still going up and headed into technological breakthrough, remember that technological breakthrough is an S-curve-like moment, which means it's an inflationary system which breaks through in parabolic scales until there is the logarithmic reduction, because of course breakthroughs cannot sustain forever. There is a moment in which of course the market shares of new development in this ecosystem are limited, and then we get to the attitude plateau, which is basically there are consistent improvement in the technology, but definitely not vertical as it did before. This is like the same old stuff. Each and every year we get better improvements on the tech itself, but this is marginal improvements over time. There is the adoption curve, which is basically what you need to come out of this is that this is this curve. Most of its growth is terminated in here when we reach 50% adoption in the population, which is generally turning from pragmatists to conservatives, which is basically in here most of the pragmatists but still pro-innovation will adopt, and of course the conservatives who are fighting against, like no, this thing is too disruptive, I'm not going to use it, finally get to use it anyway because it's a revolution. That's the thing. So the adoption comes into spiking around that phase. What's necessary to understand is that it happens after the technological breakthrough, and most of the time the adoption curve comes out of peak of hype. So actually having a peak of hype is a good stuff. Actually, every revolution comes with these early stages of over-speculation, selling the future, and inflated expectations. Comes the truth of delusionment, the actual sort out of the supply, shake out, and then comes the actual revolution itself, the technological breakthrough, when out of multiple competitors, if there are some, one will stand out of the crowd by offering technological situations and solutions that others can't copy. They have an advance that others will take years to catch up on when, of course, the market will mature. The adoption will center around that leader actor, and that's exactly the same old model that we've seen for smartphones with Apple's breakthrough technology in apps, phone and stuff like that. This is what we've seen with the internet adoptions and stuff like that. So this is definitely the way it is, okay? Technological breakthrough will lead adoption, and the adoption at that technological breakthrough stage is not the one of visionaries. The technological breakthrough happens when the pragmatists are going in. That's really a very important thing that you need to understand. Out of this model, there's one thing that I really want to point out very, very clearly is that lots of people misconceptions comes along the fact that multiple of these breakthrough technologies can happen in the same time, but at different time scales. And that's exactly the number one mistakes in cryptos. People thinking that we can sort it out as a big crypto stuff with a big C, capital C, when actually turns out we have multiple sub-revolutions happening at different time scales. To put it mildly, today Bitcoin is of course passed through the chasm, and we can clearly see that because whoever is gathering the supply now is the smart money. The smart money has been accumulating more than any other preceding bear market, so tokens have been shuffling hands and we've gone through the chasm. The smart money has bought the Bitcoin, which means now is next the pragmatic adoption. We might have gone wrong with the 2021 bull market that has been created out of thin air and basically printed tokens and double countings and basically accounting manipulation in the worst case scenario. But basically, despite the fake start of the 21 bull market, we're still in that phase in which the chasm is there, the tokens have changed hands, clearly the adoptions have passed the charms, and the next one is to come the pragmatic adoption. So the supposedly institutional adoptions that have been sold in 2021 is definitely coming along the way. It's just that some people just sold it a bit too early, probably a couple of years ahead. Though this is where we are in terms of Bitcoin. I mean, Bitcoin is almost here today. It's on the verge of its technological breakthrough, though don't expect Bitcoin to change radically in the short term because Bitcoin is a long fucking daddy. This thing has taken more than 10 years already, so understand that Bitcoin will reach its maturity stage in here and its maturity adoption obviously approximately 10 years from now. Well, of course, this is not linear scaling, but just an approximation. So Bitcoin is a much longer daddy game. Ethereum has been doing this in just 4 or 5 years and is at the exact same stage today. Most of Ethereum supply has been shuffled after the visionaries saw the ICO era and stuff like that, and oh, Ethereum is the future, bro. Well, it turns out it wasn't able to scale for that demand. We've gone through the chasm today. Ethereum supply has very little chances not to be adopted by pragmatists, as the breakthrough will show up with the adoption of layer 2 technology, decentralized identities, and like we see it, real-world tokenized assets, which will all, in my personal opinion, give a new breath, much more sustainable and pragmatist type of adoption than buying fucking ape NFTs and shit like that. So I think Ethereum is on the verge to separate from the rest of the market by its ability, its security, and decentralization that nowhere to be met by the competitors. Remember all the ETH killers of 2021? Not everyone has survived, and they're actually all in the downtrodden area. So Ethereum is right here. It's about to succeed. Definitely have Ethereum on my portfolio in an overweighted manner. I'll explain about that, mostly due to the 60-40 portfolio allocation I talked about previously. There are other cycles in here because basically lots of assets like the AVAX, the Solanas, the Theta's, and a lot more others like that have been through the peak of hype, meaning that they definitely have inherited a technological trigger that has been overinflated and now is in a trough of disillusionment. And they're currently in the charts, which means the Solanas, the AVAX, and stuff like that getting their supply diluted, and we'll see what comes out of it. If the supply is taking by the smart money because they envision the pragmatists to adopt the technology, then of course there will be a chance for this to happen. Of course, remember that even smart money professionals don't know anything about the future. They're risk-taking their investments. But remember that if you're investing in all of those things that pumped and dumped in 2021 and faked in 2022, this is basically, if these assets have no more than 1 year history, which is the case for most of them, well, that means they are in a cycle that has been lasting for 2 years. That means they have 2 years to recover and get to their full market potential if they succeed. So don't be dumb enough to think that all of them will succeed. The Solanas, the AVAX, and the Sun, there are very little chances there will be technological breakthrough and adoptions to every of those technological solutions. Most of them, despite how good they are, may die, because that's the way it is. It can risk, there's a matter of risk limitation. Okay, so really understand the multiple factorials of how we are advanced in this system. Multiple things are happening in parallel, and people try to mix it all up together, despite the fact that there are clear evidence that the time scales at play are far from being compatible. Lots of things are happening at different speeds, and you need to understand that. Last but not least, that's the model that I use to figure out the chasm, which is basically how do we differentiate revolutions from absolutely bullshit stuff. They generally tend to follow the pattern. So TLDR in here is that if I had to couple it with the previous model, you have to understand that the chasm in here is where things get sorted out from those who will roll back and just basically that was no more than future telling stories, and only the hype will ever recover, but anyhow and anyway it goes to zero because there's nothing behind that. And those who truly get adopted, have technological breakthrough, and have adoptions of pragmatists and then conservatives and so on, okay? Though the chasm is the center of the piece, is the center of the maze. And I have a model that says this is generally how it tends to behave. During the chasm, we see, of course, the inflated expectations of those people, so you'll see the disrupted kind of class, though there is the disruptors and the disrupted, okay? They're separated by this line, and that's what this model says. In here, you got the disruptors behavior. In here, you have the disrupted behavior. Though the disruptors will say, okay, they've gone too far anyway. Our tech is so good. Future is us. On the opposite of it, on the opposite side of the equation, the disrupted will say, well, they're definitely stupid thinking that they can shuffle the deck, and they are getting dangerous with these things because their tech isn't sustainable, isn't sustainable. They're really putting our system into a dangerous state, like, you know, financial stability risks and all the bullshit we've seen back then, investors' protections, all of these things. Though it follows through an absolutely dangerous set of stuff in which cycle by cycle, one of these cohorts is going to take over control and have absolutely irrational behaviors. That's definitely the sign to me that the chasm is going on. If I see the pattern, I know that there is a likelihood that we get through this with the final stage, which is both of those parties will actually tend up to agree that this was obvious. This was obvious that this technology will take over the preceding way of doing things because it's just more efficient. But before we go from that, they're dangerous, out of we are the future anyway into both of them agreeing that this was obvious, there is a set of psychological mismanagements. Though the red code is for the bad negative emotions and the blue one is for the two extremely positive ones, both of them are actually going extremes. So the first one is the opposite way of someone losing control when someone thinks it's taking control. This is generally the phase one. This is what we've experienced in 2021, basically. The disruptors think they're taking control, like Solana is going to replace the NASDAQ. AVAX is going to replace that, and it's going to do all of this bullshit. This is really like, we took control. Look at the price, bro. The adoption is here. No, it's just selling the future. That's basically all about it. There's a euphoric behavior, denial of risks, and excess of competence. On the other hand, the lose of control, which means the actual disruptive technologies, and here we'll say, whoa, boys, this is bullshit, fight, flight, or denial. They get angry and violent against the disruptors, though this is basically the same old thing. Investors' protections, these guys don't know what they're doing, we need to prevent them from doing, we need to regulate, okay. Then comes the resignation and capitulation phase against nervosity and doubt, which is kind of a more going back to neutral, which is basically these guys start to understand that, well, maybe there's some disruptive technology behind that, so we're going to have to resignate and capitulate and assess the fact that, well, we might have to eventually start to adapt in the future. Of course, this is the moment in which those who thought they were taking control, it's going to the moon, bro. It starts to not going to the moon. After breaking resistances after resistances, we start to break supports after supports, and comes out the nervosity and doubt. Well, maybe that wasn't the future, or at least there's something going wrong. We were supposed to break resistances, bro, and go to the moon. All of my targets are now being further away, and we're breaking supports one after the other, though this is dangerous. And then comes the latest opposite reaction, which means the good old world is saying, well, we are finally adapted, we are back to business as usual, we've liquidated all of the guys who were swimming naked, and they will have revenge or punitive kinds of behavior that will be like, well, now we're going to make regulation, we're going to take taxes of these things, we're going to just put you guys down. You tried, but now we took control. No, it's not the thing. Once again, they don't have control because in shuffling the supply, there's still a lot of people who are still there. Because there is, on the opposite direction, a lot of delusion. People who will just get the hell away, fight, flight, or denial, because basically that's too much for them to handle. Some of them are actually fighting to death, which means basically they've been buying and buying each and every dip with leverage. They end up being wrecked and forced out of the market. But despite those guys, there's a lot of people who will just stay there. They're in the delusion phase. They're like, well, damn it, I've done so many shit. I could have sold and bought now with much more tokens in hands. I'm so stupid, But still, these guys hold on. They handle the delusion phase. They could have done better, but they're still there, which means a lot of the supply is not circulating because these guys still believe. In the end, it's obvious, the adoption comes in, and like we stated, this is where the pragmatists kind of show up. The pragmatists adopt the technology not because they're selling the future, bro, but just because the tech is fucking working. And we have the technological breakthrough that supports the fact that there's going to be even more demand because of use cases, not future storytelling, but true market breakthrough technology use cases emerging day by day as the technological breakthrough goes into its parabolic scheming break. So this is really the way it is, okay? You have to understand these models, and we clearly have gone through the chasm when it comes to Ethereum. Pragmatist adoption is definitely there. The use cases of Ethereum are not future-telling stories now. Tokenized real-world asset is already fucking happening, and that's just the beginning. There are lots of other things that are happening with technologies like NFTs and decentralized identities, non-fungible tokens, SBT, the cell-bound tokens, and all of these things are going to come into the next cycle. They will have clear use cases now, and it's not about selling a bright future, it's just creating it as we go on. That's really the way it is. So Bitcoin, Ethereum, definitely, folks, pragmatists are at play. Bitcoin is definitely used as a store of value today and as a money alternative system against fiat currency, as a hedge by institution. It's not a myth anymore, it's the reality. It's just that we might have been teased a bit too early in 2021 by a bunch of bullshit liars who have, just like every liar out there, been proven wrong because they can't last. People may sell story, but if you cheat, you're inevitably going to be uncovered. Though 2022 has been all about that, uncovering all of those liars Now, there is still a chance that there might be some of them with the Genesis, DCG stuff, but until then, those who gamble on the fact that this is inevitable might have some troubles, because if it doesn't, for whatever reason there is, the market will retrace right up to moving averages. We'll see all about that when it comes to the risk management phase, but at least in here we wanted to present all of the different models. Last but not least, I will give you a quick look in the second part at different charts, and I'll show you my exposition in the crypto portfolio. But that's for part 2. So that's enough for the modeling. See you guys in part 2.